Good afternoon, class. I'm pleased to meet you and let you hear my voice and let me talk through some problems together. This is a huge leap, I think, in what online education can be, as well as pulling you into more like what a seated experience is like with me. I'm using a document reader to do this with a voiceover, so you're not looking right at me. I may do that later. I worked on it earlier today, and there's a little bit of a bad glare from the whiteboard, and so I'm thinking that I would maybe rather do it this way. So what I'm going to do at this time is we are going to work through exercise chapter 2 SE 5, 6, and 7. We're working them all as one problem. We're really going to take it a step beyond what 5 says. 5 says to go through all those transactions and say what account would be debited and what would be credited. We're actually going to do it like a journal entry so that we can talk through each one and talk about what it affects and how it would look as a journal entry. Then we will post to T accounts. T accounts are what we use to simulate having a general ledger. So all the T account is a place for you to collect up several journal entries. And you'll see how important it is, especially with cash or any kind of an account that has a lot of activity. If you don't have a general ledger account, you would have no idea how to collect up the activity in that account, and you would have no way of knowing what the balance should be at the end of the activity. So basically, we are recording for this company what's happened in their business, in Sean's computer programming business, for the month of May. And you will also notice that this is a brand new company, which is why he opens up his business with a big investment. Okay, so let's go ahead and look at May 2nd. This will give us an opportunity to talk about a lot of different issues. So on May 2nd, it says that Sean Michael invested $10,000. Okay, well what that means is that he took his own money out of his own savings account and deposited it into a company checking account. Okay, so that means we are going to increase cash, and you know cash is an asset, and assets are increased with debits. So we are going to increase cash by debiting it for $10,000. Now, I know the whole debit and credit thing makes people crazy, but when you look at the accounting equation, you see that the assets are on the left and the liabilities and the owner equity are on the right. And assets are increased with debits. So debits on the left. Liabilities and owner equity are increased with credits, and they're on the right. So that kind of gives you a little bit of intuition for the left and the right. And then remember that if assets are increased with debits, they are decreased with credits, and vice versa for liabilities and owner equity. So let's go on. So what's the flip side of this? Well, he made an investment in his company, so that means that's owner capital. So owner capital has been increased. Okay, so right now we have a balance sheet that shows $10,000 in cash and $10,000 in equity, in owner equity. And that balances, and that is the whole balance sheet after this first transaction is recorded. Okay? I think, I'm trying to figure out if I should do the T accounts as we go. I think we'll go ahead and do that. So cash is up 10,000, and I think I will start more T accounts over here. Owner capital is up 10,000. So I'm just recording in the T account, debits on the left, credits on the right. This is just like a general ledger page in the accounting system for the company. Okay, on May 7th, or May 5th, sorry, we purchased a computer for $5,000 in cash. Well, that computer is something we're going to use in the business for a long time. That computer is an asset. We are using it in the business. If I was a computer store, he is a computer programming business. That's a service. If I was a computer store, I would have some computers that I use in my business, and I would buy other computers that are actually inventory that I would resell. In this case, he bought a computer, and it is to use in the store. So I will call it a computer account, knowing this is an asset. It's increased 5,000. It said he purchased the computer for 5,000 in cash, so that means he wrote a check. He wrote a check. That tips you off that cash is decreased, so we have to credit it. Okay, so I'm going to credit cash down here on the T account. I'm going to make another T account for computer. Okay, so we're just keeping up with our ledger as we go. On May 7th, purchase supplies on credit for $600. Okay, when it says supplies, when your author says supplies, he means supplies inventory, which is an asset. If he had said supplies expense, he would have meant for you to put it on the income statement, put it in the expense accounts. So we purchase supplies. So supplies, which is an asset, is going to increase. So that's a debit. Okay. Now, when somebody says they purchased something on credit, then what that means is they ordered the supplies, the company shipped the supplies and bills them, and we will pay later. Okay? So we owe people. We owe the company we got the supplies from. So we purchased them, so we need to go ahead and record that we have them, but we're going to pay for them later. So that means it's going to sit in accounts payable until we pay our bills. Okay? So accounts payable is just exactly what it says. Payable. What accounts do we owe? What accounts are payable? Accounts payable. Okay? May 19th. Received cash for programming services performed. Okay, so we did some programming for someone, and they paid us immediately. So in this case, when it says we received cash, that means we're going to deposit that money, and it's $1,000, and we've already done the work for them, so that's revenue. We've earned it because we've done the work, so we go ahead and record it in revenue. Let's see, I need to make some more. I'm behind on the T accounts. Let's hop back and post. Let's see, let me continue on with assets over here. Supplies are up 600, and accounts payable payable is up 600. I don't know what this is doing. Oh, shoot. Go back. Okay, where is it? Oh.